Okay, let's just wait a couple of minutes to see anybody else will join us tonight. If not, we'll get started and talk about the review problems. Okay, I think we need to get started. And let me share my screen with you. And let's first go through these review problems. So right now, it should be my screen. And I'm switching to the final ACT 500 final exam review. Okay. And let's first go over the first problem on our review sheet. The first problem is to evaluate the effect of alternative depreciation methods on key ratios from an analyst perspective. And my main interest in this problem is to demonstrate how do we depreciate a depreciable item using the three alternative methods, namely straight line method, units of production method, and double declining balance method. Okay, so let me get let's follow this and check. The first one is the straight line method. Straight line depreciation method is the most widely used method for depreciation, and it's pretty straightforward, as its name says. Straight line depreciation, very straightforward. Okay. You are a financial analyst for Ford Motor Company and have been asked to determine the impact of alternative depreciation methods. For your analysis, you have been asked to compare methods based on a machine that cost $106,000. The estimated useful life is 13 years, and the estimated residual value is $2,000. The machine has an estimated useful life in productive output of 200,000 units. Actual output was 20,000 in year 1 and 16,000 in year 2. And we need to route results to the nearest dollar. Okay, for this problem, we have all the information we need for depreciation. And the machine cost is 106,000. And remember, according to GAAP, all the assets should be recorded or reported as their historical cost. So it's recorded as original purchase price, the original cost, $106,000. And the useful life of the machine is 13 years. So the machine can be used for 13 years in total. The residual value is 2,000, which means that at the end of its useful life, the machine cannot be used. But it may be sold for like scrap metal. And if we sell the machine as a scrap metal, we can get like $2,000. This is the example of residual value. Okay, and we need the productive output 200,000 units when we use the units of production methods. Okay, so let's with straight-line depreciation. So the original net book value is $106,000, right? And in year one, the computation for the depreciation goes like this. It equals to the original value, historical cost 106,000 minus the residual value, which is 2,000, and depreciate over 13 years. This is the annual depreciation expense. And let's do the calculation. So 1,000 subtract by 2,000, we get 104,000 divided by 13. What do we get? $8,000 per year. So here, using straight-line depreciation method, we know that it is $8,000 per year. And during year one, the accumulated depreciation equals to the depreciation expense. Okay, in year one. Let me remove this. So accumulated depreciation equals to depreciation expense in year one. And
Dr.
the net, yes. Who's speaking?
Yeah, Dr. Wu, this is Mr. Ujori. I lost the network.
I'm sorry, what did you say? Voice getting cut off.
I have a technical problem.
You have a connection problem? Oh, you cannot see what I write?
Oh.
Okay. So we are talking about the. So your voice is on and off. So I think your internet has some problem.
Yeah, my connection has problem.
Yeah. Can you get a better connection?
It's a network error. Software calls connection about received failed.
Okay. My suggestion is that you log out and log back in to see if this can solve your problem. Close your browser, restart the entire program. Okay. Okay, so the original book value is 106,000, and after at the end of year one, we need to get the new net book value for the machine. So it is what? 106K minus 8K, which is 98,000. 98,000. Okay. This is what we have for year one. For year two, straight line depreciation. Okay, the computation is the same. Straight line depreciation expense is the same every year until the net book value drops below the residual value. Okay. So in year two, the computation is the same, 106,000 minus 2,000 divided by 13, which is also $8,000 depreciation expense per year. And accumulated depreciation, okay, equals to 8,000 accumulated depreciation in year 1, plus another 8,000 depreciation expense in year 2. So the new accumulated depreciation would be 8K plus 8K equals to 16,000. And net book value is what? Is original net book value 106,000 minus 16,000, and we get 90,000. Okay. And this is a straight line depreciation method. I showed you how to do this, and this is very important because straight line depreciation method is the most widely and commonly used method to account for depreciation expense and accumulated depreciation. Any questions? Okay, we have Amos and Joshua join us. Any questions? No question. No question. Okay, let me move on to second method. Units of production method. Okay. Units of production. And these units. The machine has an estimated useful life in productive output of 200,000 units. So during the life of the machine, it can produce 200,000 units. And actual output was 20,000 in year 1, 16,000 in year 2. So units of production method, depreciation method, means that the more production, the higher depreciation cost. Okay, so because the machine is used more. So under this rationale, we have this units of production depreciation method. Continue to take a look. And yeah, year 1, year 2. Let's see computation. Then we have depreciation expense, and we have accumulated depreciation. And the net book value. As we know, the net book value before year 1 is the original net book value, 106,000, right? In year 1, how do we calculate the computation? How do we calculate the depreciation expense? And first of all, before we get started, we need to compute the per unit depreciation cost. Okay. So original cost 106,000 subtracted by 2,000 and divided by the total output 200,000 units, and we get 0.52 per unit of output. Okay, how do we get 106 minus 2, 104 divided by 200,000, 0.52. So it tells us that for each unit of output, the depreciation cost is $0.52. In year 1, we actual output 20,000, right? So we have 52 cents per unit times 20,000 units equals to 10.4K. Okay. Depreciation expense is 10.4K. Accumulated depreciation in year 1 equals to the depreciation expense, 10.4K. And net book value in year 1 is what? 106K minus 10.4K, which is, let's see. Okay, let me see. $95.6K. This is the net book value of the machine at the end of year 1. In year 2, the actual output. So we have this information: 52 cents per unit times 16,000 units. And let's see what do we get. 0.52 times 16. We get 8.32. Depreciation expense in year 2 is 8.32. 8,320. Accumulated depreciation is 10.4K plus 8.32K. And we get 18.72K. And net book value is 106K original cost minus accumulated depreciation, 18.72. Equals what? 106 minus 18.72. We get 87.82K. 87.28K. 87,280. This is a units of production method. Any questions?
Nope.
Okay, good. How about other students? Do you have any questions? Okay, these two methods are pretty straightforward. Okay, let's move on to the last one. Double declining balance method. It is also called accelerated depreciation method. Double declining. Declining method. Double declining balance. Okay, so this method is the most, like I would say, it's computational sophisticated method. Most sophisticated method. Okay, let's check it out. Year 1, 2. Okay, and we have at acquisition, computation, and we have depreciation expense and accumulated depreciation. And the net book value. So at acquisition, the net book value is 106,000, right? In year one, how do we compute the double declining balance method, depreciation method? Okay, in year one, let's see, how do we do this? It is 106,000 subtracted by 0. Okay. Multiplied by 2/13. Okay, why is 2/13? Because usually it should be divided by 13, but it's double declining, so we multiply by 2. And let's see what we get. times 2 divided by 13, we get 16.308. Okay, I would say 16,308 depreciation expense. Year one accumulated depreciation equals to year one's depreciation expense. 16,308. And the net book value is what? Net book value is 106,000 minus 16,308. 106,000 minus 16,308. 89,692. 89,692. This is year one. In year two, the computing for depreciation expenses goes like this. It is 106,000 subtracted by what? 16,308. The year one's depreciation expense. Then we have multiply 2 divided by 13, not 3. And we get 106,000 subtract 16,308. Okay, 89,692 equals to the net book value of year one times 2 divided by 13. It is 13,700. Okay, 13,799. 13,799. Accumulated depreciation equals to what? 16,308 plus 13,799 and equals to what? 16,308 plus 13,799. 30,107. 30,107. Okay, the net book value. Book value equals to 106,000 minus accumulated depreciation, 30,107. and equals to what? 106,000 subtracted by 30,107. 75,893. 75,893 dollars. Okay. Any questions? Let me go back to the screen. Do you have any questions?
No.
These are three methods. Okay, thank you, Tom. No questions. Let's see.
I have one question about the rounding.
Evaluate. Yes. Yes.
If we run into a situation on the exam where the intermediate answer is 0.5, should we normally plan to round up or round down?
0.5 you round up.
All right, thank you.
You're welcome. And don't be concerned too much about the rounding issue because I allow like 2% deviation from the standard answer. So if you are up 2% or lower 2% compared with the correct answer, you will get the full credit for it. So I take that into consideration. I give you a 2% allowance.
I have another question. When we are doing our own work, we always have a problem with round-up.
Okay.
They specifically tell us not to round more than 2 decimal places or 1 decimal places. Are we going to have the same problem when we do the...
Look at the... Okay. Like this problem, it tells you the round results to the nearest dollar. So you will be asked to round to the nearest dollar. So you don't have those digit problems because you will be round to the nearest dollar amount, not to those decimal places, right? And I believe if you have rounding issues, it should be corrected by itself. And because I always impose like a 2% or even sometimes 5%. If your answer is within the 5% range, up or below 5% of the correct answer, you will get the full credit for it.
Thank you.
You're welcome. And the next one is say problem. So I don't think I'm going to ask you to finish the essay problem, but I want to tell you how to answer this type of question. Expect you to understand. Okay, like for evaluate each method in terms of its effects on cash flow. Okay, first let's take a look. For cash flow, okay, which method gives us the best cash flow? I mean cash inflow. Okay, I would say that's the double declining method, which is the most favorable method for cash flows. Why? Double declining method can generate high tax deductions at early stage, right? Because it generates high expenses, high depreciation expense, high expense, high deduction. So from the tax perspective, the company would pay reduced tax at early stage. And early tax deduction is preferable to a later tax deduction. And so double decline depreciation expense is the highest. It yields a lower taxable income and therefore lower income tax payable and lower cash outflow in early years. And in later years, this effect will reverse. Okay. But we always want to have high deduction in early years than later years. For example, we have like 403 if you work, if your company gave you like retirement plan, 403B plan, or 401k plan. These plans allow you to make deposit, to contribute to retirement, and you don't pay tax right now, but you pay tax later on, right? Why because you want the best tax deduction right now instead of later on. This is the same story. Double declining method gives you the early tax deduction rather than late tax deduction. So it is a preferred method to increase your cash flow because you pay less tax in the early stage. How about the effects on the fixed asset turnover? The double declining method would be the most favorable method for fixed tax turnover also, because the depreciation yields the highest amount of depreciation expense, and it yields the lowest level of net fixed assets. Okay, highest amount of depreciation expense, lowest level of net fixed assets. Thus, the highest fixed asset turnover during the early years. Again, in the early years, high depreciation expense, low net fixed assets. So we also want to use the double declining method for fast fixed asset turnover. For EPS, earnings per share, okay, then what would we do? We prefer the straight line method. Okay, this method, straight line depreciation method, has lower depreciation expense compared with the double declining method. Low depreciation expense, high net income, and high net income would lead to the higher earnings per share. Okay, earnings per share equals net income divided by the number of outstanding stock shares. Okay, this is a different method. Its effects on cash flow, fixed asset turnover, and EPS. Basically, we're just comparing the double declining method or accelerated depreciation with a straight line depreciation. Units of production method is not should not be included in our discussion here because we don't know how many units are used. It may lead to high cash flow or may lead to low cash flow. It fluctuates. The depreciation expense fluctuates with the actual output of units. Okay, next. Assuming that Ford Motor Company is most interested in reducing taxes and maintaining a high EPS for year one, what would you recommend to management? Okay.
Double declining.
Yes. Double declining method. Because double declining method can reduce tax burden, can increase tax deduction, reduce tax burden, right? And if they want to have a high EPS, they would choose the straight line depreciation method, right? Because it has less depreciation expense, generates higher net income. For year two, we may change as time goes on. In years 2 or later, the relative advantage of one method over another will reverse. So double declining in later years may lead to higher tax expenses, and straight line depreciation in later years may lead to lower EPS. So it will change. Our selection depreciation method would reverse. Okay, just something I want to let you know. And you won't be tested to write an essay for this. Okay, you may write some method selections, choose which method to fill the blanks, but I'm not going to require you to write an essay to explain it to me. Any questions for the depreciation method? 3 depreciation methods. If I haven't heard any response from you, so we can move on to the next one. Okay, let's move on to problem 2. Problem 2 is recording and reporting current liabilities with discussion of the cash flow effects. Sturgis Company completed the following transactions during 2012. The annual accounting period ends December 31st, 2012. Okay, January 15th, recorded tax expense for the year in the amount of $125,000. Current taxes payable were $93,000. January 31st, paid accrued interest expense in the amount of $52,000. April 30th, borrowed $550,000 from Commerce Bank, executed a 12-month 12% interest-bearing note payable. June 3rd, purchased merchandise for resale at an invoice cost of $75,820 on account. July 5th, paid June 3rd invoice. August 31st, signed contract to provide security service to a small apartment complex and collected 6 months fees in advance amounting to $12,000. Record the collection in a way that will not require an adjusting entry at year end. December 31st, reclassified a long-term liability in the amount of $100,000 as a current liability. December 31st, determined the salary and wage of $85,000 earned but not yet paid. December 31st, disregard payroll taxes. So required, first, prepare journal entries for each of these transactions. First requirement, we need to prepare journal entry. So we do this one by one according to the chronicle order. Okay, first, January 15th. Recorded tax expense for the year in the amount of $125,000. Current taxes payable were $93,000. Okay, January 15th. So tax expense would increase by $125,000. Tax expense account. Expense increases, we put it on the debit side, right? So tax expense increase, we debit $125,000. Current taxes payable were $93,000. So we have taxes payable, which is a liability account. Any payable account is a liability account. Tax payable liability. Liability increase. We put it on the credit side. $93,000. And the difference is what? The difference is deferred tax liability. Deferred tax liability, which is $32,000. This is for the January 15th transaction journal entry. Well, tax expense increase, debit by $125,000. Taxes payable increase, we credit. Payable liability, $93,000. And the difference goes to the deferred tax liability, $32,000. Okay, any questions? No question. Excellent. Let's move on to number next, January 31st. January 31st, accrued interest expense in the amount of 52,000. Interest expense is paid, so interest expense is reduced, right? And interest expense is reduced. So let's see. And we paid accrued interest expense. So it means that it implies that we had interest payable before. And we pay off this interest payable. So interest payable, any payable is liability. If payable is paid, so liability is reduced. Okay, then the credit. We reduce the interest payable by 52,000. And okay, how do we pay the interest payable? We use cash. Cash assets. Asset reduced, put on the credit side. Cash is reduced by 52,000. January 31st. Okay. Borrowed 550,000 from Commerce Bank, executed a 12-month 12% interest-bearing note payable. Okay, they borrowed money from the Commerce Bank. Okay, and they executed a 12-month 12% interest-bearing note payable. And bear in mind that the interest, without any special declarations, the interest is always annual interest rate. Like this 12% is annual interest rate. Okay, it's not quarterly interest rate, it's not monthly interest rate, and not daily interest rate. It's always annual interest rate. Okay, without any other declaration. Okay, unless you borrow from some loan sharks, they may charge you like 12% weekly interest rate, right? For regular bank, always annual interest rate. Okay, let's see April 30th. On April 30th, they borrowed 550,000 from Commerce Bank. They borrow money, cash will increase. 550K. And in the meantime, notes payable. Or note payable. Okay, they borrowed one note. Liability increase. Remember, any payable is a liability account. Cash increase, liability increase. Okay, for April 30th, we are all set. June 3rd, purchased merchandise for resale at an invoice cost of 75,820 on account. June 3rd. Okay. They purchased merchandise for resale. So they purchased merchandise inventory. Invoice cost 75,820 on account. So this tells us that they don't use the cash. They purchase inventory on account. So inventory would increase 75,820, and account payable would increase 75,820. For the June 3rd. Are you with? Okay. Take a look at July 5th. Pay June 3rd invoice. Okay. So they pay off they pay the accounts payable July 5th. 1 day after July 4th holiday, right? They pay off the accounts payable, so accounts payable balance is reduced. Liability reduced, we need to debit it. 75,820. And how do they pay? Accounts payable, use cash. Cash asset reduced, we credit it. 75,820. Both is reduced. August 31st, signed contract to provide security service to a small apartment complex and collected 6 months fees in advance amounting to 12,000. Record the collection in a way that will not require an adjusting entry at year end. Okay, I will deal with this issue. August 31st. We have they sign the contract to provide security service to a small apartment complex and collected 6 months fees in advance amounting to 12,000. They collect fees, cash goes up 12,000. And the deal, the contract, okay, was for 1 year, right? And so we have revenue. Revenue 8,000. And deferred revenue 4,000. Because the contract was signed on August 31st.
Now, why wouldn't that be a deferred revenue of 12,000 completely?
Because they collect 6 months fees in advance, right? So this is kind of unearned revenue or deferred revenue. Some portion of it is deferred revenue.
But is there a reason that the entire amount is not deferred because they have not started the work yet?
The entire amount is not deferred because look at here, record the collection in a way that will not require adjusting entry at year end. So what we are doing here, I assume that the 8 months has already passed, right? So has reached 8,000. So altogether, the entire year's rent service revenue is 12,000. Divided by 12, 1,000 per month, right? Now it is August 31st, so 8 months. So 1,000 times 8, 8,000 earned, and the remaining 4,000 is deferred. I understand in this way.
I find that one confusing.
Yeah, this one is a little bit confusing. I agree with you.
If it's not to confuse everyone, but if it's a 12-month contract and they took in this amount of cash, and there's only 4 months left in the year, wouldn't they book 4,000 in revenue and 8,000 deferred?
Let me double check. Okay.
Because it's 1,000 a month for the 4 months remaining in the year.
Mm-hmm. So it's 12-month service contract, and they collect 6 month fees in advance.
And in actuality, it's even further off because it says 6 months worth of fees amounting to $12,000, so that would be $2,000 a month.
Right.
So,
I demonstrated here before. Okay, I need to make a correction. This 12 months is okay. I need to make a correction here. I'm sorry. This 12,000 is for 6 months, right? So it's 2,000 per month, right? And from August 31st to August 31st to December 31st. How many months? 4 months, right? And 2,000 times 4 is $8,000. This is a correct way to explain it. And because the collection does not require adjusting entry at year end. So at the year end, the revenue would be 8,000, right? And the unearned revenue, the deferred revenue would be the remainder. 12,000 minus 8,000 equals to 4,000 is the deferred revenue. Tom,
excuse me,
explain? Yes.
Excuse me. Yeah. So which means it's not a 12 months contract.
It is not 12 months contract. It's 6 months. I need to. Yeah, I made a mistake before. It's 6 months. So every month the service revenue 2,000, and since they do not want to require adjust the entry in the year end, so we just assume that at the end of the year, December 31st, from August 31st they sign contract, and December 31st is the reporting date, year end. So the service revenue earned would be 2,000 per year times 4 months, $8,000. And deferred revenue would be 12,000 minus 8,000, 4,000 would be the revenue to be earned in the next year. Deferred revenue to be earned next year. Is this clear?
Yes.
Okay. Very good. The trouble that which will require an adjusting entry at year end. If without this statement, we can just record the entire 12,000 as deferred revenue or unearned revenue. It's a liability, right? But because of this requirement, we need to make a little bit adjustment. And thank you, Tom, for pointing this out. Next, we are all set. I think the next thing, prepare all adjusting entries required on December 31st, 2012. Adjusting entries. Okay.
What about the transaction for December 31st?
I'm doing it. I'm working on it right now, actually. Let's see. December 31st. Let's see. First, December 31st, we need to pay attention to one transaction, which is related to the April 30th transaction. They borrowed $550,000 from Commerce Bank executed a 12-month 12% interest-bearing note payable, right? So interest expense and interest payable. The company incurred interest expense and interest payable would also increase. Interest expense would increase. Interest payable would also increase. What's the amount for the interest? Okay, we have the principal, $550,000, and 12 times 12% interest rate. This is for 1 year, right? And the money was borrowed from April 30th to the end of the year, December 31st. How many months in between? April 30th to December 31st. How many months?
8 months.
8 months, yeah. Very good, 8 months. So we divide by 12. This is interest expense per month times 8 months, right? So we solve this. This 550,000 times 12% divided by 12 times 8. 4,000. 44,000. So interest expense increased by 44,000, and interest payable would increase by 44,000. Okay, this is one. And the other is December 31st, reclassified a long-term liability in the amount of 100,000 as a current liability. We need to reclassify it. Long-term liability as current liability. So long-term liability would be reduced. Long-term liability would be reduced by 100,000. We debit it, and the current liability would increase by 100,000. Right? Another transaction on December 31st is determined salary and wages of 85,000 earned but not yet paid on December 31st. Disregard payroll taxes. Okay, so we have wage, salary wage. So wage expense increase 85,000, and but not yet paid. So wages payable would increase by 85,000. Wage expense, salary, wage expense, and salary, wage payable. 85K, 85K. Increase, the expense increase, salary, wage payable, liability increase. Okay, we finished the requirement 2 for the problem. Any questions? Show how all the liabilities arising from these transactions are reported on the balance sheet at December 31st, 2012. Okay, let's see, how do we deal with this issue? all of the liabilities arising from these transactions reported on the balance sheet. Okay, let's see. And what type of liabilities do we have? Liabilities. Okay, December 31st, we have salary and wages payable, right? 85,000. Salary, wage, payable, 85,000. This is one liability. And okay, the first one, current tax payable was 93,000. So we have taxes payable, 93,000. And we also have deferred tax liability. $32,000 from the first transaction, January 15th transaction. And on December 31st, we have another, remember we have a, for the April 30th borrowing, notes payable, we have the interest payable liability. So interest payable, we just calculated 44,000. And we also have the rest for the all signed contract at the end of the year, 4,000 deferred revenue. It's also a liability. Deferred revenue is also called unearned revenue. 4,000. And another liability is the note payable. 550,000. And we also have a reclassification of liability in the amount of 100,000 as the current liability, current portion of long-term debt. $100,000. So add them together. We have total current liability let's see. $85 plus 93 plus 32 plus 44 plus 4 plus 550 plus 100. 908. 908,000. This is the answer for requirement 3. Like total liability amounts to recorded as 908,000. Okay. Number 4. Each transaction state whether cash flow from operating activities is increased or decreased, or whether there's no effect. Okay, let's see. On January 15th, right? We are required to calculate to answer what? Cash flow from operating activities. Increase, decrease, no effect. January 31st. Record tax expense for the year in the amount of 125. Current taxes payable were 93,000. And no tax were paid. So the answer is no. For January 31st, paid accrued interest expense in the amount of 52,000. So they use cash to pay interest, accrued interest expense, to pay interest payable. So the cash is reduced, it's decreased. Cash flow decreased. April 30th, borrow 550,000 from Commerce Bank. Execute 12 months, 12% interest bearing notes payable. Okay, the cash increases. However, the 550,000 cash increase is not from operating activities. It is from finance activities. They borrow a note from the bank. So the cash from operating activities is no effect. June 3rd, purchase merchandise for resale at an invoice cost of 75,820 on account. No effect. Purchase merchandise on account. No effect on cash flow. July 5th, paid June 3rd invoice. So use cash to pay the accounts payable. So which would decrease the cash flow. August 31st, sign contract to provide security service to a small apartment complex and collect 6 months fees in advance amounting to 12,000. Okay, so August 31st, they collect cash for the service in advance. So the cash outflow will increase. December 31st, let's see. Reclassify long-term liability in the amount of 100,000 as current liability. No effect on cash flow. Determine salary and wage payable, wage of 85,000 earned, but not yet paid on December 31st. Not yet paid, no effect. Hey, any questions? For the review problem 2. Okay, no question. I haven't heard any response from you, so I assume you don't have any questions. Now let's move on. Number 3. Comparing stock and cash dividends. Carlton Company had the following stock outstanding and retained earnings at December 31st, 2011. Common stock, the par value is $1. Outstanding total number of common stock outstanding is 500,000 shares. So the stock value is recorded as 500,000. Preferred stock 8% means that the preferred stock has a dividend rate of 8%. Par value $10 per share. Outstanding shares in total is 21,000 shares. So 10 times 21,000, 210,000. Retained earnings 900,000. Okay. It's 1 times 500K equals to 500,000. 10 times 21K, which is 210,000. Retained earnings 900,000. The board of directors is considering the distribution of a cash dividend to the 2 groups of stockholders. No dividends were declared during the previous 2 years. No dividends declared the previous 2 years. 3 independent cases are assumed. Case A, the preferred stock is non-cumulative. The total amount of dividends is 25,000. Case B, the preferred stock is cumulative. The total amount of dividends is 25,000. And case C, same as case B, except the amount is 75,000. Required. 1. Compute the amount of dividends in total and per share payable to each class of stockholders for each case. Show computations. Okay, let's see how we solve this one. The amount of dividends in total and per share payable to each class of stockholders for each case. Case 1. First stock is non-cumulative. The total amount of dividends is $25,000. Case 1. Case A. Preferred is non-cumulative. And total amount dividend to distribute. Total dividend is $25,000. Okay, so see, cumulative. So the previous 2 years dividends is paid, were not declared. Okay, were not paid, were not declared. So if it's not declared, it's gone for preferred stock because it's non-cumulative. Let's see. Let's see, preferred stock. Preferred stock is entitled to the dividend amount of what? Which amount? So the total preferred stock par value is $210,000. $210,000. And it is 8% dividend rate times 8%. It equals to 16,800 total. So preferred stock in the current year are entitled to receive 16,800 dividend in total, and 16,800 divided by the number of shares. How many shares? 21,000. So 16,800 divided by 21,000, 0.8 dollars per share. Okay, this is for preferred stock. For common stock, okay, preferred stock has a priority over common stock in terms of dividend receipt, dividend distribution. So total dividend 25,000 minus the dividends 16,800 for preferred stock. Remaining goes to the common. So for common stock. $8,200 in total. 8,200 divided by the number of shares for common stock, 500,000. So what do we get? 8,200 divided by 500,000. So $0.016 per share. Okay. $0.064. This is case A. Any questions? Okay. No question. Then move on to case B. In case B, the preferred stock is cumulative. And the dividend paid declared is 25,000. Okay, because it's cumulative, so the preferred stock, they have dividends in arrears. Means that the previous unpaid dividends should be paid this year. So how many dividends were unpaid? In the previous 2 years, no dividends were declared. So 210,000 times 8% is the dividends per year times 2 years. What do we get? $210,000 times 8% times 2. 33,300. 33,600. Okay, this amount is larger than 25,000 dividends paid declared for this year. So what will be the result? The result would be the preferred stock would get 25,000 dividends. In total for this year. It cannot be over $25,000 because the total dividends, total amount dividends is 25,000. Okay. And per share is 20,000 divided by 21,000 shares, right? One share stock. So we have 25,000 divided by 21,000. $1.19 per share. For common stock, no dividends. No dividends. Zero. All the dividends go to the preferred stock owners. Any question? Okay. Yeah. Do you have any questions? Okay, I hear my voice echoed back to me. Okay, let me move on to case C. In case C, same as case B, except the amount is 75. So preferred stock is cumulative. And the dividend is 75,000. Okay, we have got a higher dividends amount. So the preferred stock for the received dividends in arrears, which is 210,000 times 8% multiplied by what? Multiplied by 2 years, which is we did in case B, 3,600, right? And for current year, they receive 210,000 times 8%. For current year, it is 16,800. So in total, they are going to get $50,400 in total. And per share is 50,400 divided by 21,000 shares. So 50,400 divided by 21,000 shares. $2.4 per share for preferred stock. For common stockholders, they take the remaining part. So 75,000 minus 50,400, and we get $24,600 in total. And on a per share basis, 24,600 divided by what? Divided by how many shares? For the 5 divided by 500,000 equals to what? 24,600 divided by 500,000. $0.0492 per share. This is dividend per share for common stock. Any questions? So preferred stock has a president has a priority to receive the dividends, and it's non-cumulative means that there's no dividends in arrears. Previous unpaid dividends are gone. They're gone. But if it's cumulative, we have dividends in arrears and dividends for the current period. Any remaining dividends goes to the common stockholders. That's a basic principle for stock dividend, for cash dividends for stockholders. Okay. Requirement. Assume that the company issued a 40% common stock dividend on the outstanding shares when the market value per share was $50. Complete the following comparative schedule, including an explanation of the comparative difference. So in this case, they have 40% common stock dividend. Okay. When the market on the outstanding shares, when the market value per share was $50. So let's see the cash dividend and the stock dividend. And cash dividend, case C. Stock dividend. For assets. For assets, if it's cash dividend, they use cash to pay the cash dividend, right? To pay the dividend. So cash reduces. Cash reduce, assets reduce. 75,000 decrease. Because cash account reduces. Stock dividends no effect on assets. For liabilities, let's see. Okay, when the 75,000 cash dividend is declared, the current liability increase on declaration date, and on the payment date, $75,000 stock dividend liability would decrease. So the net effect is 0. So current liabilities increased by 75K on dividend declaration date. And the current liability decreased by 75K on payment date. Dividend payment date. Net effects 0. The net effect is 0. Stock dividends, no effect on liabilities. Stockholders' equities. Stockholders' equity for cash dividend, okay, 75,000 decrease because retained earnings are reduced. Retained earnings is reduced, okay, and no effect for stock dividend. So in summary, a cash dividend decreases assets and stockholders' equity by the amount of the dividend because the resources were used to pay the cash dividend. Cash was paid to the cash dividend. However, stock dividend does not change total assets or total stockholders' equity because no resources are dispersed, are paid. Only the internal content of stockholders' equity is changed. There will be more stocks. The number of shares will increase. Okay, it's 10 o'clock. Okay, 10:01 actually. Any questions? Last review problem.
One question. Hello?
Yes. Yep. Go ahead.
Are we going to base the exam on the last 3 chapters?
Yes, the exam will be based on chapter 8, chapter 9, and chapter 11.
You're not going to base it on the other chapter we did before?
It will not involve other chapters. But, some fundamental knowledge like debit credit are sure to be used. Some basic accounting, skills are expected for you. Debit, credit, what are assets, liabilities, stockholders' equity. These basic fundamental concepts are needed. But it will be based on 3 chapters, chapter 8, chapter 9, and chapter 11.
Did you announce the date of the exam yet?
I believe I put it in the syllabus. So I will put the exam online tomorrow night, and it will be due on the last day of the exam date. So I think it's May the 18th, next Wednesday. Is it good for you?
Not as good as the 19th, but better than the 17th.
Okay. Yeah, I cannot do it on the 19th because all exams are expected to be done on the 18th, according to the schedule.
Just kidding.
No problem.
It's done on Wednesday.
Where I
What
haven't
time? What time is it due on Wednesday?
Wednesday midnight. So it will be due on 11:59 Wednesday night. So I will give it to the last minute to as the deadline.
Do you know how many questions? How many questions is going to be in the exam?
It's the same as the previous two exams. So I would expect to have like 40 multiple choice, 2 big problems. Altogether, we have like 50 questions, 50, 40 multiple choice, 2 big problems. Like will be based on the review problem. So the multiple choice problems are based on the quiz problem. And you will still have 3 hours, 3.5 hours to finish the exam. That's plenty of time. One shot. So if you want to prepare for the exam, go through all the problems in the quizzes, one by one.
I have a question.
Yes.
When will the grades be posted?
The grades will be posted 3 days after the final exam. So 18, I would say like 21st. Or I will probably do it, I will try my best to post it on the 20th, 19th or 20th. Okay?
And they'll be available for the transcripts?
Yeah, I think so. Because the last exam date is the 18th. I'm expected to post the grades 3 days after the exam. So it will show up on your transcript.
Can I ask a question about the retained earnings and the capital stock? I'm looking at the book right now. When the company issues 400 million shares of stock, they do a journal entry that debits the retained earnings and credits the common stock. Aren't retained earnings part of shareholders' equity? The book
retained earnings is part of shareholders' equity, yes.
The book shows that it has it shows the journal entry as retained earnings being debited for $400 million and common stock being credited for $400 million. And then below that, in the assets equals liabilities plus stockholders' equity, for some reason it shows both of those journal entries under the liability section. Is that incorrect?
Let me get the book. Okay, just a moment.
It's on page 563. That just didn't look like it made any sense to me.
Can you tell me which page are you referring to in the textbook?
Page 563 at the bottom. I think it's just an error in the book.
563, right? Okay, let me see. Stock dividend, stock splits. It should be under the stockholders' equity, not the liability. I agree with you. You have very sharp eyes. There's an error in the book. I can write an email to the author of the book. Okay, anything else?
I want to thank you for having this again. It's been an enjoyable semester with you, and great class.
Mm-hmm. Thank you
I
very much.
agree. Thank you very much. It was very enjoyable and very helpful.
Mm-hmm. Okay, thank you so much. It is the first time
Thank you very much.
This course is offered online. I have a very good group of students, so I should thank you for all your cooperation, and hopefully I can see you either in my online class in the summer for 650, or probably see you in my physical class, okay, face-to-face class in the new semester next academic year, or in the future. Okay. Okay, thank you so much.
Thank you very much.
Mm-hmm.
Thank you very much and good night.
Okay. Good night.
Thanks, everybody. Good night.
Mm.
Good night, everybody. Good luck on the exam.
Good night.